The first point is being self-aware. And that's one of the things that through the philosophy, I've also been studying human psychology. And it's just one of those things that to answer the question that you have is human beings oftentimes are just irrational. I wouldn't call it irrational, but it's human nature. So meaning that if something's going up, then let's say an investment in stocks or crypto, whatever it is, that let's say stocks, that when everything's going up, that's when people have the fear of missing out effect and they start investing.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Sterling White is a multifamily investor in the Midwest. He has owned up to 500 units. He's also been a Bigger Pockets contributor since 2014. Sterling, you've been on the show before and certainly appreciate you coming on back here again with us today. Welcome to the show.
Yes, and thanks for the intro there and the energy, the tone, and everything. I think I just may clip that part and just have it at the beginning of my podcast, or just whenever I enter a room, I'll just pull my phone out and play that.
That's awesome, man. Sterling, it's great to have you back on. You know, there are, for our listeners maybe that didn't catch your previous episode, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
So started Indianapolis, Indiana, rougher parts of the city, single mother, fraternal twin brother. Ended up getting into real estate. This was 2009, where things were not so good in the economic environment as a construction laborer. I read the book Rich Dad, Poor Dad, which rich and wealthy people did not get that way by being laborers. So then I started buying single family. Got up to 150 and then transitioned 2017 to multifamily, got up to about 500 units. So there we go. That's 31 years and 60 seconds, I believe, is what I did.
Yeah, you did, man. You definitely kept it under the 90-second threshold there. Certainly appreciate that. That is awesome. So you scaled up to 500 units in your own personal portfolio. And then things have changed. We've had a market shift. Like, tell me what you guys are doing today and how you guys are positioning yourself.
Yeah, so have been selling over the years and just have one apartment left, which is 156 unit, which is now under contract and waiting to close. It was a fire at the property and now going back and forth with insurance. So it really pushed it along, but actually received $1 million more than what we had on our 5-year projections, and we're 2 years into the project. So that just goes to show with where we're at in the market at this moment. And I believe that there's going to start to be even more of a shift. So want to have that dry powder available and ready.
That's really kind of wild. So, I mean, and we're seeing that across how many assets? I mean, everybody in the multifamily business seems like, oh, we're hitting our projections sooner than what we thought. We are getting more than what we projected. And it seems like for you think it's a good time to sell.
Oh, yeah, for sure. With what people are paying. And it's just one of those moments that, well, the perfect time I would have said would have been 6-8 months ago, but now is the other from that. But is what people are paying in the overall settlement, and people are, just wanting to park their money in real estate. So when you get all of this influx of cash, yeah, it's a really good time to sell.
What do you expect? So what do you expect to happen? A lot of times when you look at market dynamics, you say, okay, now is a great time to sell. That is because there is anticipation of something different in the future. What are you anticipating?
One, we've got the quite a bit of uncertainty that's going on, the rise of the interest rates. And also, I just believe what people are paying for properties right now is just not sustainable. And I'll give you a prime example. The 80 unit that bought it for $3.35 million in 2018, and then a year and a half, 2 years later, sold it for $5 million. I have no way how that person made those numbers work, because we're actually operating the property. We're saying, how did they make that work? So I believe those deals will start to come around.
So what you're saying is that you are in, and again, this is kind of, not asking you to predict the future, but your, I guess, conclusion is that people have, or hypothesis, that's the word I'm looking for. Good grief. Can't find my words today. Is that there's people that have overpaid for properties. And then they're going to come back here in the near, 6, 12, 18 months and say, oh my gosh, we've overpaid for these. And now we have to unload them at a discount. And you're anticipating picking those up.
Yeah, and I made that mistake overpaying for a property and ended up having to sell, what was this, 12 months, a year and a half after that, because didn't raise enough cash to take care of the improvements because overpaid for the property. And if would have raised that money up front, it would have affected the investor returns. So it was already an okay deal without raising the cash, and it would have. So in essence, is that same mistake I believe people are making. Not everyone. I'm sure some people are buying deals at a good price, but just from what they bought it for, I just have no clue how they're making it work.
That is I mean, and again, that's not your problem necessarily. When someone else is overpaying for a property, you just, but you can obviously collect the proceeds from whatever it is they're willing to overpay. So you see, it's now a good time to sell. You think, yes. What do you do with that capital once you have it? I mean, that's something that a lot of people are, questions that a lot of investors and us as active or passive investors, but also active investors have is how do we protect the purchasing power of our capital? I mean, the published inflation rate is what, 9%? So let's say you get a windfall of millions of dollars, you unload all your assets. So you're sitting on millions and you go, well, now what do I do with it? How do you protect that from the, erosion of inflation?
That is a great question because I don't have the answer to that because one, real estate's overpriced. And then I've invested into other sectors. And when I invested, it ended up getting cut. And some of those investments getting cut in half and actually went down. So it's exactly what you mean is it's uncertain times with what to do with your cash. I still decide to invest it because having it in the bank is you're losing money due to inflation, but I don't have the answer to that. It's very tough right now.
Absolutely. Absolutely. Are you guys still in the acquisition game? I mean, are you still looking at assets, still underwriting? Are you doing anything on that front?
Not at this moment. I just haven't, because the approach that I've always taken is on the multifamily side is the direct to owner and outreach. So build a whole entire system with that. And it's a lot of work that goes into that. And so for that is the amount of work versus the ROI and what I saw from an economic environment just couldn't justify that the efforts that we put in for the ROI that we got.
Yeah, and you guys had, for those of you again that are just tuning in and have not heard Sterling's first episode, when we conclude this, I'll go back and find the actual episode number. Normally I know that if I have a repeat guest, and I didn't look that up ahead of time, so I apologize. But if you go back and find that episode, you'll hear some really creative sourcing strategies and outreach strategies for acquisition. Sterling did some really cool things. I won't repeat those here, but certainly worth a re-listen or a first-time listen if you want to go back and find that episode and find some really cool methods that Sterling was using to find direct-to-owner deals. So that's really interesting. So you're saying that the amount of time and effort that it takes to ramp up, especially your really unique strategies, it's just not there right now.
Correct. Exactly. And still, once things do start to turn, I already have that foundation set and the knowledge is just returning it back on.
Right. It's flipping the switch. And then you have, capital in the bank and it's flipping the switch. What are you doing right now to really stay sharp and then to know when the market has turned to a point to where you want to get back in?
So it's stabilizing the current asset being that apartment, but also is I've taken on more, I wouldn't say more, but actually is different hobbies, meaning is I've taken the time to step back and actually sharpen more of my axe, meaning my mindset, which is taking on more philosophy, learning a different language. And so those are more things and rabbit holes I've actually gone into during this time.
Now that's really cool, and there's always that there's that confluence of money and time that people rarely run into in life. Like everybody seems to work for those golden years where it's like, oh hey, look, we're retired and we got time on our hands and money in the bank, and it's like that's just it happens at few intersections. I feel like in most people's lives. So it sounds like you may have found that intersection, albeit potentially temporary. And this is what you're pouring into. So tell me, on the philosophy side of things, why do you think it's important to really work on the way you think?
And I wish more people actually talked about these types of things. Because yes, business, fantastic. Always want to improve on that side. But I believe actually, as a human being, you improve yourself. That will, what is it? Not only you'll be better of value to people out there in just the common world, but also in your business as well. But is just one of the philosophies I've been studying, or just what is it, reading up on, is like Stoicism. There's Taoism, and just one of the things I've taken on is that people are going to be people, accepting that the good, the bad, and the ugly, and just to not take anything personal that some people may do, and that they're acting in their best interest, which many of the times their best interest may not be in your best interest. So accepting that, and then also is the things that you can control and can't control, which there's a lot of things out of our control, such as if Sam came on this podcast and just leaned in onto me and said, you know what, you were, I don't know, make some things up. You're a bad investor. You're underwriting all this. I can't control that, but I can control my actual response to it.
Right. Yeah, man. And getting that's funny. You mentioned that. I mean, I think it's what it is. Somebody said it, that life is 90%, or it's 90, or how do they say it? 90% or 10% what happens to you, and 90% how you respond to it. There we go. Get my numbers right. And getting that mindset set to where when things happen that are outside of your control, you can just go, that's just I can't fix that. The only thing I can do right now is decide how much energy I want to devote to whatever that event was, and then figure out how I want to respond to it. And outside of that, I got to just let it go.
Yeah. And I'll give you an example. In my earlier days when starting the companies I had, that is, I was working on myself, but there's different layers to it. And I'll give you a prime example. If someone sent over a not so nice email to me and they had multiple points, is sometimes I would just, each and every point, I would respond back to that email. But now I'll give you an example. If a employer or someone sends that over to me, I'll just, instead of emailing and respond to them or getting triggered or frustrated or mad, is one, I don't take it personal, and I'll just hop on the phone call with them just to talk it out and completely take the angle. And many times is it actually what they had in the email was not intended of how I actually perceived it.
Right. Right. Yeah, that's absolutely great. Yeah, I find that as well. Hitting those things, or not hitting them on the head, but just addressing them head on. It's like, hey, you know what? We're not going to email back and forth. We're not going to chat over whatever it is, Google chat. We are going to just talk. And a lot of times that whatever you had perceived is not actually what was going on there. That's really cool. How is this affecting you as an investor? And maybe if you're working on your personal philosophy, how does it affect the way that you foresee yourself investing in the future?
Well, there was that one example that I just mentioned there from the business side, but also the accepting things can't control is I'm not able to control what's out there in the economic environment, such as the Fed increasing the interest rates, or let's say some black swan event happens in a war. We have World War III. Hopefully this doesn't get banned for me saying that, but is that those are events that I cannot control. So in the event that those do happen, I believe that will actually be a opportunity for the investing, because when there's blood in the streets, that's the best time to actually invest.
Yeah.
Counterintuitive advice though, because when it's actually happening, you're like, oh gosh, yeah.
I know, and that you bring up an interesting point there, and it's something I've long thought about, but I don't have an answer to, which is that investors typically invest at the completely wrong times. Going back to your point there in the beginning, which is that you're unloading all your assets because people are paying numbers for them that you can't have it make mathematical sense. You're like, this is just dumb. Sure, you can buy it. I'll let you buy it for that, no problem. But one of the things that I struggle with is getting out in front of, because we syndicate opportunities. I don't know if you syndicate your deals or if it's all in-house, but educating our investors for the right time to invest, to when everybody else is afraid, being able to instill confidence in the people around us. How do you see yourself doing that?
Yeah, the first point is being self-aware. And that's one of the things that through the philosophy, I've also been studying human psychology. And it's just one of those things that to answer the question that you have is human beings oftentimes are just irrational. I wouldn't call it irrational, but it's human nature. So meaning that if something's going up, then let's say an investment in stocks or crypto, whatever it is, that let's say stocks, that when everything's going up, that's when people have the fear of missing out effect and they start investing.
Right.
And then once things start to a black swan event or people happens in the economy, that's when it's at the top. Because at the bottom, when people were scared, that's actually when the wealthy and the smart money came in. And then when things start to go up, retail or the common investor comes in. The at the top, the smart money actually starts selling off. And then let's say a black swan event. And then from there at the bottom, then that's when retail starts to sell.
Right.
So it's just understanding that psychology, and just when things are fearful, and let's say when in the real estate market, 2008, 2009, 2010, that was actually the best time to buy.
It most definitely was the best time.
But the scariest.
Oh, for sure. For sure. 2009. I mean, could you imagine going out and taking down a $30 or $40 million apartment complex in 2009? People would be like, so you're doing what again? Like, is anybody making money in that? None of their friends are making money in it. There's not these, 2x, 3x equity multiples in 2.5 years that everybody's seeing. So it's a really interesting kind of thing that you have to figure out, is how to communicate to investors and instill confidence, when everything does seem to be, or could potentially be, going the direction that most people aren't comfortable with.
Exactly.
Tell me this: if you were to give advice to somebody else looking to get in the business right now, or looking to scale their commercial portfolio, and somebody came to you and said, "Hey, Sterling, I'm looking to jump in, man. What should I do right now?" What would you tell them?
So is this a person just getting started? Or
let's say they're like you and they had a single family portfolio, but they want to get out of that game and get into bigger assets.
So I would say one, patience, but also is, if you're on social media or whatever the case is, you're saying, okay, I need to get a deal now because I see all these other people getting into it and I haven't, and I no longer want to be in single family. I need to get this deal now as a way to build more credibility, or whatever reason you're just in that mindset, that in more of a non-patience, is I would just say patience. It's okay. I know we're in the microwave age and it seems as if everything happens overnight, but that's not the case. And one thing I've learned, because if we're speaking in today's terms in 2022, is that, one, yes, I haven't acquired anything for the past several years, but I've learned from people who are further along than me in their journeys. They've had those dry spells where they didn't acquire, but then when they did acquire, when things did shift in the market, they really scaled during those periods of time. So that's one thing, as I always study others, but also constantly take a step back and practice patience as much as I can.
Man, that's great. That's a great advice. Yeah, because I like the way you put that, in the microwave age, because it's so true. It's so true. We see it, we hit the button, and 30 seconds later, we got I'm going to call it a meal. I'm not going to call it food, but I'm going to call it a meal. Most of what comes out of a microwave, I'm not going to wouldn't qualify as probably food. But either way, it's something to eat. So we're used to that instant. And especially as you see on LinkedIn or you see on Facebook or Bigger Pockets, and you're like, oh, hey, cool. So-and-so just acquired another massive, transaction. You're like, golly, I'm just sitting on my thumbs. Oh, maybe.
Yeah. And you don't know what all the work that they had that went into that. That could have been an owner that they've been following up for 3-4 years now, that they just didn't have the time to put all that in the actual post or give that backstory, or they could have just overpaid for the deal. You don't know none of these things. So, and that's the thing that Earl Nightingale, through all the, the self development and mindset I went into, is just keeping up with the Joneses. That is one of the worst things. And that's why I work to not be on social media as much as I can off of it.
That's interesting. That's very, very interesting. Yeah, because the FOMO, then the feelings of like I'm not doing enough, or I'm not moving fast enough, or things like none of that really generates any positivity, I think, in our life, or actually moves the needle for us any. So I think that's a really, really cool point. Tell me this. So you guys, you're selling off your portfolio, you're working on yourself, you're working on your mindset, you are developing your own philosophy. You said you're learning a language as well?
Yeah, Spanish. I can speak it, but difícil cuando personas. I don't want to get too much, but it's difficult
when
for
people
me
talk
to
to you.
listen.
Yeah.
see.
I caught it. Well, you're ahead of me, man. I can't speak it. So I can't, and then that's really, really cool. I love the ability to, and the willingness to keep your mind sharp. That's a really big, I think, piece of the puzzle. I guess the last question maybe for you is this, so we talked about some risks that are out there in the marketplace, and you see people overpaying for things. Are there other risks that other people are taking on right now that you feel like you found a creative way to offset and or avoid altogether?
I'd say is believing that cap rates are going to keep steadily compressing. So that's one risk when looking at and analyzing deals. Let's say right now it's the current properties trading at, let's say, a 5 cap. Instead of underwriting in, let's say, a 3 to 5 year projection, that it's going to be at a 4, maybe even a 3. I'm just using that for example purposes, that likely just keeping it at a 5, 5.5, or maybe even a 6. So that's what I would say is a mistake to avoid.
No, I think that's really, really great. Yeah. And who knows where the cap rates go, and who knows, they may, the Fed may come out and just keep interest rates where they are. They might cut them. They might just keep raising them. I don't know.
Who knows? But that is the thing. As an investor, you just have to assess your risk and protect your downside. And I see it commonly, people not protecting their downside. And a quick story is that there was an investor, they were buying a property, and they were buying the property based upon a corporation signing on to the lease, which would be premium rates for their tenants. And I asked them, well, what does the deal look like if the corporation does not sign on? Because they didn't get anything on paper. And they said, I wouldn't buy the deal. And that's what I mean, is just not protecting their downside. Because if they buy the deal, in that case, corporation doesn't sign on. Now what are they going to do? It's not protecting their downside, because they couldn't ship that to market because it doesn't make sense.
Yeah. Oh man, that's scary stuff when you hear deals that they only they're only good deals based upon one major investor or one major source.
Everything has to go right, basically.
Exactly. It's like it is owning a business with one major client. It's like the people that, oh, well, this is my $1 million a year client. And then what do you do when that client goes somewhere else? You're hosed. So
exactly. Yeah.
Man, that's wild. Sterling, one last question for you here is this. If you were to rewind the tape over your entire investing career, what is one thing that you would do differently and why?
Man, and I know you probably get this quite often, is if I were to change something, that could be, I don't know if you watched the movie The Butterfly Effect with Ashton Kutcher, but
maybe
is basically he kept going back in time to always change one little thing. But when he would change that thing, it would impact the future heavily because of that one. So that's the thing, is that, but if I were to go back just for the podcast purposes, I would say is being more patient with myself when it comes to, or accepting the things that you can control and not control. And when first initially starting out, I had to have so much control that in this department, and really get into the nuts and bolts and oversee. But if you want to quickly scale, and then also free up your mind from that, because there's a lot of mental energy that goes into that. So that's what I would just tell myself, that you don't just learn to let go.
Man, I love it. Absolutely love it. Sterling, thank you for taking the time to come on yet again here on the podcast. Look forward to, putting this out and letting the world hear where you guys are in your investing career. Certainly love it and love what you guys are doing. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yes, you can find me at sterlingwhiteofficial.com. One more time, that is sterlingwhiteofficial.com. And then on YouTube, I contribute quite a bit of content on a weekly basis. Just type in Sterling White, look for a bald, handsome guy. I'll come right on up.
Sounds great. Sterling, thank you again. Have a great rest of your day.
You too.